So good evening, friends. Again, a very warm welcome for joining us for today's webinar. I am Kumar here from Finso's Product and Advisory team, and I'll be your host for today's webinar. So, as we are all aware, we are living in a rapidly evolving market. We have heightened volatility, inflation is on rise, and Fed is hawkish. So, all of this has just given uncertainty in the market, right? And in this webinar, today we have Mr. Soumyo Sarkar, who will help us understand the current market dynamics and guide us on the way forward. Now, before we begin, I would like to give a quick introduction. Mr. Sarkar has been a Wall Street veteran and has over 35 years of experience in capital market. He was responsible for setting up and running the equity long-short proprietary trading businesses at both Deutsche Bank and Credit Suisse, and managed AUMs ranging from some $500 million to multi-billion dollars. Now, at both these places, the annualized return, net return, was over an excess of 25% returns with no down year. What it means is it includes years like 2000, 2008 when the markets were down. Still, the portfolio, the strategy managed by Mr. Sarkar gave returns in excess of 25% return. In 2010, later, he started his own hedge fund with managing assets over $100 million. Mr. Sarkar is an alumni of IIT BHU and the University of Iowa, and is actively involved in taking investment decisions for their endowment funds. We at Finso are now leveraging his rich experience and creating innovative global investment products. So over to you, Soumyo.
Good morning and good evening from a very hot and muggy day here in New York City. I hope the weather is nicer where you are. And Kumar, thank you very much for that kind introduction. My goal today is to run through several slides and give you my impression on what is going on in the global markets as of now, how to navigate it, and what kind of things we like and don't like at this time. And hopefully you'll come away with a little bit more knowledge and thought and ideas about what is happening, so you can communicate better, understand it better yourself, or if you need to communicate it with your clients, you can do that. So those are some of the things that I have in my mind as I talk today. And at the end of my presentation, which should last about maybe 20 to 30 minutes, I'll be glad to take questions now or in any written format later on. Okay, so Kumar here is going to be running through the slides. And so we're going to start with what is the current market dynamics? What are the factors that are affecting the current markets? So Kumar, if you can just move to the next slide. Okay. The number one factor, and it doesn't really need me saying it, is the factor that is affecting all global markets, which is inflation, inflation, inflation. This is the topic that everybody talks about. So we have kind of encapsulated it in this graph. And this graph goes back to around 2008. That was the last time the market crashed. And as you can see, we have plotted the inflation rate, the consumer, in terms of the consumer price index for the US, the UK, Germany, Japan, and we also threw in India. And you can see over there that most of these major developed economies have had low interest rates throughout all these periods, particularly in the last 5 to 10 years. You can see they were kind of hovering around 0 or slightly above 0, but certainly in that 2 to 3% range or lower. And in the case of Japan, and also in the case of EU, it actually did dip below 0, went into negative on several periods. India, of course, is a somewhat developed, sort of a developing economy. So their interest rate regime is somewhat different. But as you can see, right from the COVID response sometime in the first quarter of 2020, the interest rates just started rising. and you can see that the curves going up for all of them, right? And you can see right now, US, Europe is showing CPI, the latest number from US was at 9.1%, something, the headline said 70-year-old high and so on. So that is the real concern that is going on. And you can see that this is not just a US, but it's a global phenomenon. So that is the number one thing that is going on in the world. And so why is that happening? And that will lay out over here. It says central bank money printing in response to COVID and stressed supply chains, right? So COVID caused supply chains to be stressed. It caused a lot of economic distress, and the central banks just came out, guns blazing. Okay, and we have a nice chart to show the central bank response at the next slide, if you could bring it up. Okay, this is a slide that I while browsing through, found it from McKinsey Global. They came up with this chart, and I think it shows what have the governments of the world done and what have the central banks done, right? So this is the total economic stimulus crisis response. And it's better to see this in terms of percentage of GDP and not just in terms of actual dollars, because if you just look at actual dollars, which are the headlines that you see around the world, you'll see US, it would seem like the US is the only country that is doing all this money printing. But if you look at it in terms of GDP response, you can see Germany happens to be the biggest in this chart, right? So in this current phase, which is the blue color, and we compare it to the black color, is their response during the 2008 financial crisis, right? So you can see that in the case of Germany, the response was 33% of their GDP in this current crisis as compared to 3.5% in the 2008 crisis. So a dramatic, almost like a 10 times bigger response that Germany did. And you can see for Japan, 21% of GDP. France, it is 15%, and so it is in United Kingdom. And United States, actually, even though dollar-wise, it's the biggest, in terms of percentage of GDP, it was 12%. Canada, 11%. India, also a major response of 10%, as compared to 1.2% during the 2008 crisis, okay? So this, all across countries, the economic stimulus response to COVID-19 crisis was outsized compared to that what happened in 2008 financial crisis. So this remarkable chart shows what happened when COVID hit. And this, if nothing else, is the number one contributor to the inflation, which is just hitting the world around, right? So they provided this relief, and that created that huge response. There are many other factors for inflation, but this is the number one response, the economic stimulus that was done by all these countries around the world. So this chart encapsulates that well. Okay. There is yet another very big thing happening in the world, and everybody is also talking about it, and that is deglobalization, right? This too is started with COVID, but now it has also encapsulated the Russian-Ukraine invasion, right? And so both of these have caused enormous supply chain disruptions, right? It has caused protectionism and export controls around the world, right? And one of the big things that is happening right now, deglobalization, right? The world is bifurcating into blocks, right? One of the big things that was happening for the last 2 decades that caused basically a great growth spurt around the world, allowed China to become, one of the biggest, probably the second largest economy in the world, was globalization. Everything was connected, right? The flat earth concept, the things that you could do anything anywhere and you'll be at the same advantage and disadvantage. But right now the world is bifurcating into blocks, right? There's the Western alliance aligned against the Russian forces, right? Russia has gone ahead and, together with China, they declared about a month before the invasion of Ukraine that they have a friendship that exceeds anything that has ever happened, something like that. And then there are these neutral country blocks, countries like India, Brazil, Mexico. These are major economies, major developing nations. And they're kind of trying to stay neutral for their own self-interest. And so they could be considered a bloc by themselves. So So the world is bifurcating into these blocks, and there's no sign that this deglobalization is going to be ending anytime soon. Because if you look at these forces, they are in play currently, right? And we wanted to look at one example of what is happening because of this deglobalization, and I chose to talk about Germany, right? Germany, the European powerhouse, right? It was the biggest, probably one of the biggest beneficiary of globalization. And their economy was the strongest in Europe. And how did it achieve that, right? It outsourced its entire defense capability to the US, right? So spends very little in defense, right? It outsources entire financial management and currency control to the EU. Back in 2000, Germany was the leader in creating the EU, right? So by doing that, them and all the other European countries basically lost control of direct economic management of their own country and currencies, right? And what is the worst thing that has happened to Germany right now is that it outsources entire energy to Russia, right? Oil and gas, right? Germany was one of the leaders in the world in going for alternative energy, right? They gave all these subsidies to alternative energy, solar companies, wind companies, and so on. And it shut down, aggressively shut down the coal power plants, stopped trying to produce oil on their own and no natural gas supplies. And suddenly they are in complete turmoil because whatever is happening with the Ukraine-Russia crisis, Russia is threatening every day to, stop their gas supplies, for example. Just yesterday, there was a big turmoil about Russia stopping gas supplies, and natural gas prices yesterday actually shot up 10% in the US because of these tensions, right? So Russia is obviously playing politics with that, and they are running around trying to get gas from around the world. As you know, gas cannot be transported easily like oil. It has to be in LNG form. And therefore, they have to get it from things like Qatar or even from the US, countries like that, that are surplus in gas. But transporting LNG is very expensive as opposed to the pipelines that they have in Russia, right? And that takes a long time and a lot of money. And winter is coming, which is the biggest thing, right? The gas demand increases when winter is coming. What's the fourth thing that Germany also did is that they are a manufacturing powerhouse, as you know, right? And so they're all dependent on cheap raw materials coming in from all kinds of places, especially places like China. And they were manufacturing and trading these goods, and one of the biggest exporters around the world. In fact, that chart is not here, but for decades, Germany was a net exporter, right? Their exports were larger than imports. But however, in the last quarter or so, that has gone negative. The cost of imports have increased beyond their exports, a dramatic reversal for Germany. So this is obviously happening everywhere around the world, but I just wanted to focus on Germany, okay? And so what is the net result of all of that? The net result of all of that is we have a world of lower growth and higher prices, right? So that is deglobalization, which is the other big force that is hitting the world right now. So Kumar, if you could, yes, okay. This is a graph that I really love. It's produced by a guy called Eddie Yardeni. He is a well-known sort of a financial procrastinator. He talks about the markets. Especially, he loves to talk about the Fed and economy and where markets are going. And I actually used to work with him at Deutsche Bank for several years. And Yardeni recently, his research came out with this amazing chart, right? And this chart has a red and blue line, as you can see. The red line is showing the return of the S&P 500, the US index of equities, going back to 2008. And the blue line is showing the total assets, the balance sheet of the Fed, the ECB, the European Central Bank, and BOJ, the Bank of Japan combined, okay? And you see this amazing correlation between the red and the blue line. So of course the scaling is different. The red line is on the left and the blue line is on the right. But you can see that as the balance sheet was increasing, right, the stock markets was going up. Especially, look at what happened in 2020. There's that line where the balance sheet of the three major central banks just zoomed, and so did the stock market, right? The blue line just went straight up, right? And in fact, the returns exceeded almost 100% since the stimulus started. Of course, you see that the red line, which is the return of the S&P 500, is now far lower than the blue line. And that makes sense also because the markets are predicting further shrinkages in the balance sheet of these banks, which has been announced. So one of the big things going on right now is not just that the Fed and these other banks are raising interest rates, it's also that they are shrinking the balance sheet. In other words, they are stopping money printing, to make it sound more, and they're basically shrinking the balance sheet by either selling off all those assets, those bonds that they bought, corporate and municipal and mortgage bonds, they are selling them or they're letting them mature, right? So that is that thing that all these banks are doing, and it'll go on for quite a bit long time. The market is anticipating this. And so a lot of the rally in the market was caused by bank asset inflation. That's what this graph is showing. If you can go to the next graph, Kumar. Okay. The other thing that I want to talk about, and I know there's a lot of interest on this topic, particularly in India, is about the dollar index, right? Every day there's all these headlines about the rupee heading to 80 and so on. And so I just wanted to talk about it a little bit. And I wanted to put an interesting context to this. I was in India in March, and I did a live seminar like this. If you were there, one of the topics I talked about, because at that time there were headlines going around saying that the dollar is really threatened because it's no longer going to be the reserve currency and all of that. There's a lot of those messaging going around. And I took pains to explain that, that was very unlikely to happen, and that the dollar was going to remain the reserve currency, and how it has most of the trading in the world, has been in dollars. About 60 to 65% of all transactions happen in dollar, and that was not likely to change, and therefore one shouldn't expect the dollar to collapse, right? And that was just 3-4 months ago, and now people are worried at the other extreme. Is the dollar going to just keep on rallying and so on? Okay, so over here, what are the reasons why the dollar is strong right now, right? The number one reason, the basic reason, is that the US is a relative winner of what is going on around the world. The word relative is very important, of course, and maybe I shouldn't use the word winner, but basically, it is the least affected and maybe even benefiting from the crisis in Ukraine and the deglobalization and all those other things, and even the inflation that is happening, right? First of all, as I said, it is the reserve currency of the world that has not changed. But what has changed? There's been a weaponization of the dollar, as I say. What does that mean? That means that the U.S. is using the dollar's reserve status as a weapon. How is that? They froze Russian assets, right? All the central banks of the world, including India, save money at the Federal Reserve Bank here in the U.S., right? And that is India's money, or that is Russia's money. However, they weaponized it and said they put a hold on Russian assets, right? It's unheard of, and that's a weaponization. They also did that with the Afghan government after the Taliban came to power. They're not saying it's our money; they just locked it up, right? So that's the weaponization of the dollar, right? And that has created a lot of fear and turmoil about what is going on. Okay. The other big factor is U.S. is the leader right now of a more united NATO. Clearly, and also of the G20. You saw that meeting that happened, a month or so ago. Clearly, the NATO is much more united because of the war in Ukraine than it ever was, right? That's another factor that is lending strength to the dollar. And U.S. is the leader of NATO and G20. The other big one, of course, well known, is interest rate differentials, right? In other words, the interest rates that you get with dollar deposits in the U.S. is higher than what you can get in other developing nations. Just right, the US has already been raising rates, as you know. The Fed funds rate is around 1.75% right now. Europe is still at 0, but they're just about to start the rate raise cycle, right? And Japan refuses to do that, right? This is probably the number one reason why the US dollar is doing stronger than euro. It's done so much better than the euro, and particularly the Japanese yen, right? And as you, I'm sure, are aware, the rupee has actually been relatively fairly strong. It has actually outperformed euro and the Japanese yen by quite a lot. Okay, and the fourth factor is that the dollar is always the risk off currency. In other words, when things are bad, looking scary, the dollar tends to do well because it's a defensive currency, and that's the environment that we are in right now. The fifth factor, and this is a big factor for places like India and many other countries, much worse affected, is that every time the Federal Reserve raises rates and the dollar, and all these countries, especially the emerging markets, have a lot of debt denominated in dollars, and people are fearful that these companies will have difficulty paying back the debt in dollar. And therefore, as a reaction, the CFOs and so on start buying dollars in anticipation of future payments coming in, and so that they don't have crisis, right? So a company that has dollar debt, the CFO might decide a priori to buy up dollars so that they don't have a crisis if the dollar keeps on going up, right? So this kind of, and it also sort of plays into this fear cycle, and so people just keep buying the dollar, anticipating, and your neighbors in India, Pakistan, Sri Lanka, and so on, their currencies have collapsed because of all this debt, right? Okay, the one other factor there is that the US is an agricultural powerhouse. As you know, food is probably, I haven't talked about it yet, but when we talk about inflation, food inflation is probably the biggest component of all the inflation components that is coming in. If you look at the US CPI that came out a few weeks ago, food inflation was the #1 factor. And US is a global supplier of food. All the crisis that is happening in Ukraine with wheat and so on and corn doesn't really affect the US because we are self-sufficient. We are actually an exporter of food. So being a food net exporter is clearly puts US in a preferential position in this current crisis. The other big thing is energy sufficiency. This is the big difference from what happened in years ago. As you probably know, about a few years ago, because of shale oil and other discoveries in the US became essentially neutral energy. For going back decades, they were completely exposed to rising oil and so on because they had to depend on Saudi Arabia and so on, and Canada, particularly up north of us over here for the energy. And there was the big energy crisis in 1980. As you know, interest rates in the US back in the 80s, now this is going back long in history, but back in the 80s reached almost 19%. And that's when there was the energy crisis. But right now, the US is energy self-sufficient. So the issues facing Germany is not faced by US or issues facing most of the Europe, right? And natural gas, of course, we are an exporter. The US produces more natural gas than it needs, and there's LNG supplies going out from US to all across the world. So the energy sufficiency is a big thing. And finally, weapons, right? There's one lobby in the US that is quote unquote happy about the war, and that's because that's the the weapons manufacturers, because they're going to be exporting a lot of weapons to Europe and so on, which suddenly wants to be more self-sufficient. Germany no longer wants to export all their weapons from, give up their defense to US. They want to be more a strong militarily, and so the US weapons exporters are going to gain, right? So all of this is leading to a strong currency right now. But I do want to make an important statement here, is that a strong currency does not mean a strong economy. This is a mistake a lot of people have. Oftentimes, central banks like to lower the currencies when things are getting too high, because it leads to problem with exporters, right? There's a lot of multinational companies in the US which are very powerful, and they have to lower their earnings because the foreign earnings are being hit. All right. So on the right, I just show the dollar index, right? You have heard the headlines saying that the dollar index is at a 20-year high, which is correct. The dollar index is at a 20-year high, but it is not at an all-time high. I just wanted to point that out. The euro, as I point out, in 2000 or so, 2000 or so, was actually at 85 cents to the dollar, right? So right now at $1, it is weak, but it was much weaker. If you go even further back, the UK pound was at one point at parity to the dollar. Also, at the other extreme, the euro was also at $1.60, right? So the dollar was much, much cheaper, almost 60% from where it is right now. So these are cyclical in nature, and it is not really reflective of economy. And central banks often get in and try to prop up their currencies or to deflate the currencies. In this current scenario, one of the reasons why the dollar may not suddenly be very weak is because the US Fed does not have any incentive to bring down the dollar at this level. If it keeps on rising, then yes, that may happen. At this point, the high dollar is actually helping the US central bank's goal of bringing down inflation. As you know, when you have a strong currency, imports become cheaper, and therefore, longer term, that is beneficial to the inflation picture that the US central bank wants to bring down. So the dollar is kind of doing their job for them. So there is no reason for the central bank to bring down the dollar at these levels. However, finally, what is our opinion on all of this? We think that the dollar rally is more towards the end than towards the beginning. We do not really expect too much more dollar strength, maybe even some dollar weakness coming up. But there is a lot of variability around this thing, and so so that's my current talk about the dollar. So Kumar, if you may go to the next screen. All right, I want to quickly talk to the market response over here, right? You can see in the market response what has happened this year. I just wanted to show over there, right? And so we have looked at the S&P 500. We are looking at the NASDAQ QQQ. We are looking at the Vanguard FTSE All World X US ETF, right? So this is the world stock market without the US. And then we're looking at India's return, and then we're looking at Latin America's return. So basically this return picture captures kind of everything around the world, and just about everything is down for the year in US dollars, except Latin America, which at some point, as you can see, back in late March, early April, it was actually up 30% year over year. Right now, it is down slightly, but it is still the best performing market in the US. In fact, in the world, and the second best performing is the Indian market. For all the gloom and doom, it's down only around 10% or so as of a few days ago. And the other markets are pretty much bunched together. The US, the global market, and the Vanguard FTSE All World Index, they're all bunched together. And the QQQ, which is the tech-heavy market, right, is down the most and is down about 28% or so. That's the return in dollars as of this year. I want to show you something interesting in the next chart, okay? When you're sitting in India, you don't really worry about the return in dollars. You worry about what is the return in your own currency, because you're investing in rupees, not in dollars, right? So here, because the dollar has been strong, the returns look much better, right? So all of a sudden, you see that the returns around the world is no longer near 20% down. It's more like 12% down, except even the NASDAQ is no longer 28% down, it's only 22% down, right? And the Latin American markets are suddenly positive. India markets, again, is the second best performing market in the world this year, right? So it is important to look at returns in your own currency. If I was to plot this graph, not in rupee, but in Japanese yen, for example, then just most of these things will all show positive returns, right? Even in euro, the returns will be better than this chart because the rupee is stronger against the euro and the Japanese yen. And this is yet a big endorsement for investing abroad. In fact, the next chart, if you can bring it up, Kumar, shows this even better. Okay, this is a longer term chart, the same returns, but instead of looking at just 2022, we are looking at the returns for the last 5 years. But what I have done in this chart is to look at the returns for the last 5 years, not in US dollars, which people usually do, but in Indian rupee. So as you know, the rupee has depreciated over the last 5 years, and lo and behold, you're getting much better global returns, right? The top return over there, even after the sell-off, as of July 18th, just a couple of days ago, you achieved like something like 160% return had you invested in the Nasdaq 100. You got about 120% return if you return in the S&P 500, right? And the next best return was in India at about 75% or so, about 60 to 70% or so. And then the rest of the world out there, in fact, and the worst return was from Latin America. You basically got zero returns over 5 years. Perversely, this year, as you saw in the previous chart, it is the best performing market, but over 5 years, it is the worst performing market. But the main point is the return differentials between US and India, a dramatic return difference. And this is captured in this final page over here, which basically shows the return differences from what you achieved in India versus the rest of the world, both for this year and over a 5-year period. So if you look at the for this year, right, basically you got in India, just staying in India, you would have positive returns against every market except Latin America. But if you look at the longer picture over 5 years, you actually would have made 100% more being in S&P, being in the Nasdaq 100, and about 50% more being in the S&P 500. So this chart to me tells you the number one reason why you should be investing in the US, right? You would have, the past is not the future. Nobody knows what's going to happen. But we had a chart earlier showing why the dollar is strong. And the number one reason was that global geopolitics is kind of working out in favor of the US. And so there is no particular reason why the US outperformance over a long period of time would change. It could change, but as of now, there is no big factors pointing to that. And so you saw this huge return differential that you missed out on had you not invested in the US. And so that's the number one reason I could think about why invest abroad. But even with this return, as you see, the S&P 500 had this worst first half in more than 50 years. I think the number is 70 years. It had its first worst off, but the worst off is only a 13% negative return in rupee terms, which is clearly on a manageable downside. That's the way to look at this market response. So Kumar, okay, so that is what is, in summary, that is what is going on in the world. Of course, we could talk about many other different topics, but I sort of want to keep moving on this. We are kind of a little bit behind the curve here. Investment outlook. Let's go through the investment outlook as I see right now. Okay. This is something that we came out about 3 weeks ago. Just around the beginning of this month, we came out with a paper, and we said that we are cautiously optimistic about the second half of 2022 about global markets, okay? And we pointed out one big reason why we are cautiously optimistic about the second half. Remember, the first half was the worst in 70 years. So what's in it for us in second half and beyond? That's what we are really interested in here, right? So why are we cautiously optimistic? So what is the optimistic part of that? The number one optimistic part of that is because there has been a sell-off in commodities since early June. And you can see that on the left side, right? On the left side, you can see crude oil, which is down from 80 to about 55. And then you have all these other sell-offs. You can see that copper is actually now down for the year, almost 25%, right? So is dry bulk rates, they are down. Corn, interestingly, has not been down, which is a food indicator. Like corn is kind of going sideways. Remember, I said earlier that food is one of the most sticky parts of the inflation. By the way, when we talk about oil, this is not the crude oil future that you see all the time. You've heard headlines saying crude oil at $120. This is a rolling future. So if you look at crude oil, you just don't, when you look at the rolling future, it's not just the current, the latest contract, but several other contracts going into the future. And the oil right now is in contango, which basically means that the new nearer term oil is trading at a higher price than future oil, further out oil deliveries, right? So this is a net of several future oil contracts, which is far below what the current price of oil is. Okay, so That's the difference you see. Okay, so that's the number one reason for us to be optimistic. Okay, the chart on the right is the number two reason. And by the way, this chart didn't come out at the beginning of the June. This came out July. This came out 2 days ago. Okay, and this is from Bank of America, and this really hit Wall Street. Everybody has been talking about it the last 2 days. People have actually challenged this chart, and some people saying it's not correct. Whatever. But this came out 2 days ago, and it's caused one of the biggest rallies over the last 2 days. You know, a lot of risk assets really rallied a lot in the US over the last day or two on this. And this is the fear gauge, the investor sentiment gauge. You can see is at its lowest in 20 years right now, according to Bank of America survey, even lower than October of 2008, which was the lowest point till now in the last 20 years. And, you know, being contrarians, everybody jumped on this when investors, you know, are so fearful, you know, that's the time to invest, famous, you know, Warren Buffett saying and so on, you know, or there's so many sayings like market climbs a wall of worry and so on. So when the worry is so large, that was a big short term. I do want to emphasize this is a sort of more like trading signal. It's not so much long-term signal, but it clearly gave a buy signal 2 days ago when this chart came out, right? So these are two reasons why we are optimistic. There are other factors, but these are the two main reasons. Now, why are we cautiously optimistic? We are also cautious, okay? Number one reason we are cautious is because there are many reasons why the current inflation cycle is more sticky than previously. Previously, you know, there's a lot of thought that the Fed cannot just cure this inflation problem by just raising rates anytime soon. Number one reason is that the US economy, unlike Europe and China, still appears to be relatively stronger, right? Why did commodities sell off so much in June, July? It sold off because of deflationary wave coming from China principally. China just reported one of the lowest quarterly GDP at, I think it was around 0.4%. Nobody believes Chinese statistics. Everybody came out and said if China is reporting 0.4, that means it was quite a bit negative. Be what it may, China is spreading deflation around the world. Europe, everybody thinks, is in a recession right now. So all of that caused the commodity sell-off. However, if you look at this chart on the left, there was a survey that New York Times, Siena did just a few days ago, and it says that jobs are very easy and plentiful. This is very true. Job situation is still very good in the US, and therefore, just raising rates is not going to change the dynamics for most US citizens in terms of whatever they're buying and spending on all of that, right? And so as long as the job situation stays strong, inflation could be sticky. The chart on the right shows something similar, right? They did the survey and asked them, are you optimistic or pessimistic about your own financial situation, okay? And here you can see that in the total, 83% is kind of optimistic or think their financial situation is fair, right? This is quite a remarkable chart that 83% of Americans, with all this inflation, all the complaining they're doing, they're optimistic about their own financial situation. However, actually, this graph is not here, but if you ask the same people, what do you think about the country's economic situation? They're all pessimists, right? They're very pessimistic about the overall country's economic situation. But when it comes to their own economic situation, they're quite optimistic. We see this divergence often in these kind of surveys, but this divergence is even more than I've seen in recent times. So that's quite remarkable. Okay, so those are two factors to be cautious, and then there are two other very big factors which I just want to touch on. The Ukraine war, you know that there is no end in sight for that. Nobody knows what the end game is, right? Russia keeps ramping up. You know, there's a sense that Russia, quote unquote, is somewhat winning territories, but and it's Putin. Everybody understands this cannot be seen in his mind. He cannot be seen as losing the war, but at the same time, this cannot go on. And so my own thinking is that there has to be some resolution by the end of this year, but the end of the year is 6 months away. But that is the one of the biggest factors causing all the problems in the world. So that's the war going on. Nobody knows what the end game is. There's obviously big risk involved in it escalating into NATO warfare and so on. you can go down the path and make very bearish commentary coming from the war, or you could have a sudden surprise and the war suddenly, there's some kind of a negotiated settlement. One cannot rule that out, but that might happen in the next month or two. Okay. The last factor I do want to touch on is COVID resurgence, right? This, unfortunately, most of the world, except for China, has gone back to this, like the COVID is gone, it's endemic and so on. But as the BA.5 variant, they're saying is, eludes your immunity, eludes vaccination protection hugely, and so on. So there's a lot of epidemiologists that are predicting that we're going to have yet another surge in the third and fourth quarter, right? And this in a scenery where the public has kind of moved on. Nobody wants to go back wearing a mask and have all those restrictions that they have. And then, of course, there's China, which is completely off the curve. And you saw what happened. Horrible things happened in terms of lockdowns in Shanghai and Beijing and so on. And the Chinese are going to bring back those lockdowns. And the Chinese economy, being one of the most powerful economy, if that was to happen, is going to spread recessionary fears again. So the COVID is definitely the fear of COVID. What's going to happen is there going to be an even stronger variant and so on. Those fears are out there. So those are reasons to be cautious. Okay, next chart, Kumar. Yes. Okay. I want to talk briefly about the Fed dot plot. Okay. The dot plot, if you don't know, is basically a prediction of what the Federal Reserve policymakers think of where the Fed funds rate is going over time. Okay. So there is about 19 voting members of the Federal Reserve, and they each make predictions. And if you take sort of the statistical mean of those projections, that's the green line. Okay. By the way, concentrate more on the green line going into the 2022 than looking further out beyond 2023, because that keeps sliding down. But but all the governors have said they're very, very data driven. Okay, so in other words, you have to take all of these charts by a big grain of salt right now, because they're extremely data driven right now. As the data comes in, they're going to dramatically change what they're saying. But if you look at this current prediction, the mean of these 19 Fed governors and presidents who are voting on Federal Reserve policy shows that by the end of 2022, end of this year, the Fed funds rate is going to be at 3.75%. Okay. Right now, it is about 1.5 to 1.75%. So we are looking at about 200 basis points or 2% of interest rate increase between now and end of the year. That is the median estimate of from this chart, right? So it's kind of a positive thing. I mean, people are really fearful about the 1980s type inflation when, as I said, the Fed funds rate went to 19%. So here, what the mean belief is that the Feds will definitely raise rates to 3.75%, and they go into a wait and see mode and see what the data is showing. That is the best guess right now. So that's not to say they'll stop at 3.75%. Probably it'll go even higher, but where they will stop, they will definitely sort of look back and pause and see what's happening. That's the current prediction of the Fed rate hikes. Okay, so that's the dot plot. Okay, so that covers the the market outlook and what is happening in the world and what is causing it. The big picture items that are laid out. And now I just want to briefly go through the themes that we like. Okay, what do we like in this environment? We already are cautiously optimistic in this second quarter, as I said. All right, so let's go into that, Kumar. Okay, this is something that we, by the way, again published right at the beginning of this month. We are summarizing it over here. Okay, we like small cap growth. This is a big change that we have been publishing this report for a while. At this point, we like small cap growth. This is the sector that got hurt the most, right? This is all those big tech stocks, heard all about them down 50, 60, 70, even 80, 90%, right? We don't like all of them, of course. You have to be picking and choosing, but we like small cap growth. Why does small cap growth get hurt so much? The number one reason was because their earnings are future oriented, right? So when interest rates are rising, you discount much further out earnings by a bigger factor, and therefore the current valuation keeps shrinking at a much faster rate than other growth. So, but now, as you saw, we saw that inflation is actually coming down, and we are predicting that inflation would be capped at some point. Not that it's going to come down dramatically, but those fears of runaway inflation will be contained. That is our prediction, and therefore, in that environment, as of this month, we have been lacking small cap growth. Okay. Then we have the second big category, which is the Ukraine war relative winners, right? And this one is kind of easy to understand: defense spending. And in defense spending, obviously, there's a huge spike in defense spending around the world, and all the defense manufacturers are going to be winners. This is easy to understand. We also like relative to the US, and that we have laid out several times before in our presentation, why the US is a relative winner. It has been the relative winner over the last 5 years by a large margin, as you saw. And right now, there's no reason to say why that should change. If that would change, we would write about that. But as of now, we like that. Okay. We also like semiconductors in tech winners because this is so essential and important to electronics. It is also a winner from all the supply chain problems going on and so on. We like semiconductors. Okay. Cybersecurity is the whole area. Is kind of related to defense spending. If there was going to be more widespread war, there's going to be more cyber attacks. So companies that go into cybersecurity, protection, as you know, all those problems keep on increasing. So we think semiconductor, cyber security software makers, we like those two categories of companies. You also like the big tech giants. Here we are talking about the Googles and the Microsofts and the Apple and Meta, which is Facebook, and all of those companies right now, because we think that they are resilient at this point, right? They can manage the things that are going on. They have dominant positions, and they are better able to manage all the ups and downs of technology. And some of them have become quite cheap. I was reading a report that Google is trading at about 18 to 19 PE, which is one of the cheapest valuation Google has had. Meta, Facebook is obviously faces more. There's more uncertainty about what's going on with Facebook, but it is a cheap by probably one of the cheapest tech stocks if you believe their earnings have resilience, of course. So we like this. Okay, so those are the areas that we like. And if you can go into the next chart, we are continuing on the themes we like. We also like infra spending, right? Because of, and by the way, we have not talked about global warming at all, but that's yet another risk factor. There's a heat wave right outside my window over here. You've all heard about what is happening in Europe and so on. And, India has gone through its own issues. This is all causing an infra spending boom around the world. And there's no reason. And there's also aging infrastructure. Much of the West, not in India. India is building new roads and highways. In the US, it's rebuilding its highways and roads. And so big spending going on in Europe and China, of course, always there. All right, so we like infra. We like oil also. Remember, we do not like commodities in general, but oil is a special case. Oil, as you saw in that previous chart I showed on commodities selling off, oil was one of the least sell-off. And the reason is there's a supply-demand imbalance going on. There's a big demand, and the supply is not readily able to meet it because people have underinvested in oil infrastructure. No matter what, the shale oil producers in the US cannot produce more oil in the near term. It's well understood, okay? Cannot produce, do not have the capacity. Same Saudi Arabia, if you believe them, they do not have the capacity to produce. Russia, one of the biggest producers for all the talk about being, they are an oil powerhouse, and their oil supply has also gone down because they had problems with all the sanctions going on in producing more oil, right? So all of this is going on, and therefore we still like oil. I wanted to point out one other little piece of thing called the crack spread, as you can see over there. The crack spread, if some of you don't know, is the difference between the price of petrol and the price of crude oil, okay? So as you can see in that chart, it's a little bit hard to see because the years are not showing there clearly, at least I can't read them too well. But basically you can see that it's an upward trending chart, quite a bit of upward trending in the last, since COVID times, right? Except that it has had a little bit of shrinking like all other commodities. But the crack spread goes up when because of the shortage of refining, right? It is refiners that convert crude oil to petroleum or gasoline, as they call it in the US, right? So this is yet another reason to like oil, because you cannot build up a refinery capacity right away. It takes a big investment. As you know, India is actually well positioned in that. Reliance and so on is among the world's biggest producer of refining capacity, right? So there's a big shortage of refining capacity around the world, and therefore is likely to keep the crack spread higher, and therefore we still like oil. And the final thing that we like is we have taken a barbell kind of a view on the world right now. Barbell meaning that we are both growth oriented as well as we want to be kind of protective if you're kind of wrong and recession takes hold. And therefore we have put some allocation into recession risk winners. Okay, so we have two winners over there. One is consumer staples, and the other is what is called, this is an ETF called US cash cows. Okay, US cash cows is an ETF composed of companies that are cash cow rich. In other words, they're producing a lot of cash upfront. They're often big dividend payers, but not necessarily so. They just make a lot of money right now. Obviously, this is the opposite of the small cap tech growth, whose earnings are much further out. This is earnings right now. So in a recession, you like earnings right now, right? So those are cash cows. So those are the things that we like. And this is all summarized in the last table that we have. So Kumar, bring up the next table. Yes. So here I want to just show, this is very, very short term, but we just wanted to show you how has our picks done. We made most of these picks at the beginning of this month. And how is our picks done as of close? I think this is as of close the 18th, or sorry, this is as of close the 19th, right? A couple of days ago. As you can see, our picks have done quite well. We always use the Vanguard Total World Stock Market ETF as the benchmark. Okay, so the Vanguard Total World Stock Market ETF in dollars as of a day ago was up 2.5%. Okay. Our picks that we just talked about, you can see the small cap growth, one of our biggest picks, is up 6%. Many of you have heard of the ARK fund. This was also our picks. They got sold the most. Also a small cap growth play, but much more sort of riskier plays. That's up about 15%. And you can see the other returns. So most of them, our picks, very, very short term again. We are more concerned about what's going to happen in the next several months. It has started off well. So that's all I wanted to point to you. And that is pretty much my talk. Thank you very much for listening to this. This has gone on a lot more longer than I thought. We timed it at 30 minutes. It's almost like 50 minutes or so. And Kumar, I want to hand it back to you. I'll take a couple of questions, and then you can add whatever else you want to add in terms of Finso's.
Firstly, thank you, Soumyo, for such an insightful session. Given the shortage of time, we will take few questions. And so there's one question which I want to raise, and basically it's about India. People have been talking that India will not have recession. There could be recession in US markets or in global markets, but India might have a slowdown, but not a recession. So what is your view on this?
I absolutely agree with that. Because the growth factors are still lined up, so the economic statistics coming, obviously there is positive and negatives going on, but India as an emerging market needs to have growth. There could be a growth slowdown, but I'll be extremely surprised if there is a actual recession in terms of an actual contraction. Obviously, these, price of oil coming down and so on is very, very important factor. Everybody's talking about the rupee. I personally am not really that worried about the rupee at all. In fact, as I pointed out, the rupee is actually relatively strong. It's kind of hard to say that, but it is a relatively strong currency, and there's no reason to accept any kind of fears happening from that. So yes, I agree with the general view that we should expect maybe a growth slowdown, but certainly not a recession by any means.
So the next question is basically asking about what is the right way to invest in global markets, and I'll take that question. So obviously, the first option which you always have for retail investor is directly invest in stocks in the US market or global markets, which we will never advise, because most retail investors do not have that kind of a research and expertise to invest in direct stocks. Now, the second option also, like, which is easily available, is through the mutual fund route, which is like the fund of fund. Obviously, it's an easier route, but the problem over here is the type of the strategies and the funds offered. The most funds which are offered on the mutual fund space are majorly like global market or like global market funds or maybe theme funds, but they do not target the current market environment. Like, for example, what products we have on Finso platform, we have like four different products on us on our platform, and this ranges from direct equity portfolios to ETF portfolios, and each of them are curated specific for their own needs. So, like basically what Soumyo was explaining us about the global thematic or the themes which he likes, we are creating another portfolio which will only be like invested in like limited number of themes which we like and which will run actively, right? So such kind of things you might not get it like out there in the mutual fund space, because most of these funds are like fund of fund which are investing in a bigger index. So that's where like we try to come in and say like, okay, these are the products available on our platform. The one interesting question what we have right now is, what is your view on crypto markets and the NFTs? There's so much buzz around it, and cryptos have gone from like reaching all-time highs to going to booms and dooms. So, what is your view on cryptocurrencies?
Um, I'm kind of neutral cryptos. I'm not an expert on that. I do like blockchain companies more than crypto, because these are the infrastructure builders, and there is a lot more than just holding Bitcoin or Ethereum, as you know. And if you are a trader in that, you know that there has been somewhat of a rally in the crypto market in the last 3-4 days. It's gone up from Ethereum probably is up about 20% over the last 3-4 days, and Bitcoin is up. But that's a short-term trader talk. In long term, I really don't hold any views. I personally hold a very small position in cryptos, but I do hold some position in blockchain companies, which is the underlying software behind cryptos, but also behind a lot of other concepts like DeFi and so on. And also, you know, there's a lot of Wall Street interest. So I like to own some blockchain companies, but I'm neutral on cryptos.
The another interesting question, which is again with regards to India. So, if US goes for a recession, like if US economy goes into recession, the IT spending will reduce. Now, what happens to these Indian companies which are dependent on US?
Well, the Indian markets, these exporting companies are benefiting from a strong dollar, right? So that's the first thing to keep in mind. That, and also, from my understanding, a lot of these Indian companies are much more into infrastructure type software. So that's one of the things that is much more recession resistant, right? Those are not. But obviously, you know, there will be some parts of their business that would be affected by that. But I think the impact would not be that bad in terms of that, because the importing of Indian software is already more attractive because of the strong dollar, and B, also because they are much more sort of infrastructure, and they're more ingrained. I mean, you cannot move supply chains away just because there's a recession, and you don't cut back on spending into your infrastructure spending just because there's a recession. So obviously a long-term, long drawn-out recession is going to affect every industry, but including Indian infra, but I do not expect a big impact from that.
Actually, to some extent, this is also applicable for healthcare. Like they also benefit from strong dollar in Indian healthcare.
Yes, and healthcare is even more recession resistant, as you know. So that is clearly in the sort of the winner category. Healthcare spending is one of the things which is almost unaffected by inflation. So India is very well positioned in terms of their healthcare infrastructure.
This one interesting questions, like some of the meme stocks and this likes of the Robinhood Army, they had a huge run earlier, and now they've gone to like rubles. So, what is the view on those stocks? Like, what is their future now?
Well, as you know, in our picks early this month, when we picked small cap growth, one of the things that we also picked was the ARC Innovation Fund, probably one of the most representative. This fund was down as of, I think mid-year, it was down about 60% or so in US dollars, right? So, and it was down also into the fourth quarter of last year. So from top to bottom, it was down more than 70%. I personally, in these kind of stocks, I try to avoid picking winners and losers because they're very hard to do. You have to be really on top of research. In my case, I like picking ETFs, and there is a whole bunch of ETFs that are representative of that category of stocks. And in fact, if I remember, Finso itself has a couple of these innovation type portfolios that can be also invested in. So that's my view on that. I think a small position in those kind of stocks is called for at this point.
So this is one question which is a little lengthy. It's asked like, would it be a good time to step into global investments right now? And because there are two factors which will impact. One, like we'll see an uptrend in the US market, or since it's dollar investment portfolio, and there are any chances if the dollar would start depreciating, and would it impact the investment in a negative way?
Well, I have been, as you know, Kumar, I've been a long-time proponent of Indians to invest more globally, right? And it is borne by all the charts out there, right? And I'm not saying US, you should invest globally, which includes Europe and probably even some money into China, right? You can debate about what that percentage should be. Should it be 2%, 5%, 10%? I think it should be at the higher end of these ranges in my mind, because it has a lot of benefits over long term. The number one, you could talk about the protection against rupee further weakening, right? One of the things, the rupee has been in a downtrend forever, right? Its average downtrend is about 5 to 6% annually, right? And let's just assume that that's going to continue. It may be we will enter a period where the rupee is appreciating. It's absolutely possible, and there have been many periods like that. But in terms of our diversification, I don't think it's proper to worry too much about where the dollar is going. I don't know. Nobody really knows. There's no reason to expect the dollar to suddenly weaken dramatically. Let's just put it that way. So, and as you saw from my charts there, most of the U.S. markets particularly have dramatically outperformed the rupee investor from India as opposed to putting it into the Nifty or something like that. So yes, I'm a strong proponent of that, and I would do it in a gradualistic manner. I wouldn't, whatever allocation you want to do, spread it out over time so you can ride out these volatilities that may happen in markets and currencies and so on. So do it slowly, but build it up over a period of time. That would be my suggestion.
I think that's it now, because we already overshooted our time. We had a session from 6 to 7. We already crossed 7. So thank you everyone for joining us today.